And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
And welcome to my podcast. Well, this morning, we dodged a bullet. We are at a place right now in the market, and Wall Street don't want to talk about this, and the TV jibber-jabbers won't talk about it. We're at a point where the 200-day moving average is right at that perfect spot where the small mid-cap stocks, symbol IWM, are ready to break right through that. Now, why is that important? Because history shows us every time that occurs, guess what happens? The institutions, remember, they're the firepower. They're the ones that move the market. They're the fuel for the market. They dump, and they dump hard. Every large correction or crash comes from IWM dropping through the 200-day moving average. And that triggers the Dow stocks to dump. The institutions to dump. So, now if you watch the market today, what's been going on, everyone is saying, why is the market not, the yields, why aren't the yields down more? The yields should be way down. Well, again, what people don't understand is we don't have an aggressive dumping of yields because the inflation is stubborn. We don't have an aggressive dumping of yields because who controls the yield? The bond guys. And the bond guys don't feel comfortable. They see looking at inflation as, serious. And they want higher yields. That's why you're not seeing the yields come down. They believe, because remember, inflation just doesn't go away. If Trump is right, we're coming to an end of this war, things just don't turn around. People just don't back up the truck and go, bye, bye, bye. Hey, Kramer, it's all he tells you, bye, bye, bye. Listen to this cut.
And any decline from here might be an occasion to buy, buy, buy. In other words, maybe the worst is behind us. Maybe
the worst behind us. Well, let the market tell us that, not these jibber-jabbers like him. Let the market tell us. So inflation's stubborn. The Fed is staying cautious. You don't see them cutting rates. And bond traders, they say, are very stubborn. Now, everyone's asking the same question today after Trump's announcement. When's the Fed going to start cutting rates? So the institutions will start putting money back into the market, start buy again. Well, first of all, the fundamentals that they've been peddling all these years, the Wall Street suits and the TV jibber-jabbers, and they've taken parking space in the retail investor's head for years and years, that to start a rally, the Fed first announces a rate cut or anticipation of a rate cut. They start that story. Then the market rallies. Well, that's not true because institutions don't buy on rate cuts. They never have. They don't buy on rate cuts or anticipation of rate cuts. Institutions, again, don't need a perfect yield. See, they need a predictable yield. In other words, they want to see a trend. They buy on trend. That means that they want to see a steady, they don't buy because we had one rate cut at one meeting. They want a solid trend, one meeting, two meetings, really solid, that the yields are going down, they're steady, and they're not all over the place. they're not going to buy until they have proof of that. That's when institutions start putting money back into the market. And until then, the market can't move. And retail, they can buy all they want. They can't move the market. Remember what moves the market? The fuel is the liquidity, the oxygen. The fuel is those 7 components that are on the Fed's balance sheet that act as channels that take the tremendous power they have, that balance sheet power, that cash, and they push through the 7 channels to buy stocks, which is good for us because they can't hide that. So we know exactly what stocks they're buying, and we can follow them. That's why you always follow the money. You always follow the money. And you know what stocks they're buying because they leave a footprint behind of volume and pricing and momentum. So you know what they're buying and what they're not buying. So these 7 channels are very, very important. And they're very, very powerful. So, in other words, liquidity is the oxygen. Now, what do I mean by the oxygen? Well, when money's moving through the 7 channels, if the yields are high, it stops moving. And when stocks start moving through these 7 channels, now remember what these 7 channels are. They refer to them as liquidity. What they are, remember, is components of the Fed's, of the balance sheets of the 13 institutions. When you take the balance sheet of 13 institutions, that's really powerful. And the power is these components. And as long as yields are low, money speeds right through those channels, goes by the stocks they want, and the market doesn't do what it's been doing, dropping. It holds it up. Now, they don't short stocks. What drops the market is when they're not pushing money through the 7 channels to buy the stocks they want. When they stop doing that, then what happens is the buying stops, and that's when the market just collapses. So they're not in there shorting. It just collapses because the fuel's gone. Now, they need rates to keep a nice trend, direction, and consistency. We haven't seen that. It's always all over the place, up and down, up and down. You want to see, once you see that those rates are consistent and the direction is consistent and interest rates, okay, again, over time, consistent. I'm not saying 1 meeting, that's not consistent. Even 2 meetings is not consistent. Institutions, again, they don't react to one move. They react to patterns. So today everybody got excited, oh, this is it. But now all of a sudden they're disappointed, saying, wait a minute, we should be up at least 1,500, 2,000 points today. It's the end of the war. Well, that's not going to happen because what makes that stock market go up 1,500 points? The institutions. They got to buy the stocks. But they can't get their money, their cash, through those channels called liquidity because yields are too high. And by the way, for those who are not gang members, we just released what we call the Bible of the stock market. Explains everything that Wall Street doesn't explain about how the market really works. Things that you don't know, okay, that they don't want you to know. So you can go to our gift shop and buy it for $19.95. Of course, members get it free. But again, it's terrific. Anybody who reads the Bible on the market, when they put that down, it's a very short read. They just go, oh my God, I didn't know that. The knowledge is so powerful in that Bible. It's done so well, so simple, that it'll hit you right out of the gate. Go, oh, I didn't know that. That's how the market works. No wonder I'm losing money. So check it out. So anyways, the institutions don't care about the Fed's announcement. They make a big deal, but they don't care about that. They care about the 10-year yield because the 10-year yield is more important. It's the yield. And so, and that 10-year yield is everything. And then, of course, the yields tell you exactly what's going on in the market. You combine that with IWM, the small and mid-cap stocks. When those two are combined together, that's a powerful source of information. And right now, that source is telling us this market's in deep trouble. And all eyes are on IWM, the small mid-cap stocks, and the moving average, the 200-day moving average. That was going to break this morning. But it was prevented. The timing is suspicious. Trump knows how to use the market. Trump knows how to use the plunger team. I mean, even last week, I kept saying to my members, isn't it interesting? The week before, I think it was the week before, we had two 1,000 days. The Dow went down 1,000 points each day, one day 1,200. It was either 2 or 3 weeks ago. And I said, this week here, I'm talking about last week, was even worse, but the market didn't even hit 1,000 points. We were down like 300, 200 a day. And I said, the reason is because the plunger team, which is controlled by the president, because he has to write out an order to tell the Fed, to tell the 5 biggest banks to start buying stocks to hold the market up. And then when they start buying stocks, the arbitrage kicks in. Their computers are robotic. They kick in. When those computers kick in, the arbitrage computers, they trade thousands and thousands and thousands, hundreds of thousands of shares in a second. And that's what puts the squeeze on anybody who's shorting, and they have to cover their shorts. That's what's been going on. That's why you only seen the market drop 300 points, 400 points. We should have been down over 1,000 points. Now that ties into what happened today. Again, take a look at my chart. This was really, the timing could have been better. So if you look at IWM, that's the small and mid-cap stock ETF, IWM. And look at this. It was ready to cross, I mean, it was going to drop right through that 200-day moving average. And if it did, and look at our Pro 2 color-coded chart. Look at the money that was coming out. It was ready, and look at the trend we have already going. The trend was set perfectly. That's what you're looking for. It's that nice steady trend. And then, of course, institutions don't buy unless they have a nice steady trend of dropping rates. And we haven't been getting that. But look at this. So this morning, the timing was perfect. They did not drop through the 200-day moving average because the announcement came out and said, oh, guess what? Things look good. I mean, that wasn't his exact words, but he came out and basically was saying, we had a talk last night with the Iranians, everything looks good, everything's in order, we don't have to do any more bombing right now, everything looks good, and that's why the market went up. I believe that was just part of the plunger team who relayed to the president, hey, if we go through, if IWM, small mid-cap stocks, go through that market, go through a 200-day moving average, the Dow, or the industrial institutions will dump stocks. And every time this has happened in history, when IWM is going through a 200-day moving average and the institutions dump stock after stock after stock, that's when you have a critical correction or a full crash. So that's what's going on. So again, so when people say, well, why isn't the market rallying? Why isn't the institutions buying? Because they're not buying into this. They don't believe it. Again, everybody makes the same mistake. When there's anticipation of a rate cut, or there's a rate cut itself, oh, hey, let's buy, everything's okay. Now, the institutions don't work that way. Institutions don't buy on rate cuts or anticipation of rate cuts. They buy on a nice, solid rate trend. Just like when you have a stock, you're looking for that sell trend, the pricing trend to go down if you're shorting, or the pricing trend to go up. It's the same thing with the institutions who control all the money, who create the direction of the stock market. Remember, it's institutional money that drives the stock market, not the small investor, not the investor, not Wall Street. Okay, it's the institutions. So once that Fed announces a rate cut, that's not a 100% guarantee either. So again, watch IWM for the next couple of days. That's your answer. And go to our gift shop and get the Trading Bible, $19.95, free for gang members.
Are you nuts?